Welcome back, everybody. So today we are going to be looking at your money, the stock markets, inflation, and most importantly, your time. I really want to articulate the relationship between your time and your money and why this is very, very, very important to pay attention to. I also think as well, if you have a good understanding of how this Excel sheet works, it can give you a significant advantage in terms of achieving your financial goals very, very quickly. Whether that is to get financial freedom or whether that is to retire earlier, I do think understanding the rules of the game and how the game is currently being played can give you a significant advantage in terms of preserving your purchasing power and, most importantly, increasing your wealth over time. Now, let's pretty much get straight into this. So, at the top, we have the initial amount. Now, this is basically, let's say, money in the bank. I mean, let's put it as $5,000. I mean, this is relatable to a lot of people. So, let's say you've got $5,000 in the bank. You have a lot of different options what you can do with that money. So, you can put it into the stock market. Let's say you get an average return of 8%. And let's say that the inflation rate is currently 4%. And what you can do as well is you can adjust these numbers to whatever you want. So, you can say, the stock market is going to go up 10%, or it could be any different type of asset, and you can get even more creative in terms of adding different types of variables to this table, what obviously can help you in terms of projecting your overall net worth going forward or whatever. But we are trying to keep things simple over here. So again, this can be, let's say, asset appreciation of 10% a year with inflation at 2%. And again, this helps you in terms of forecasting out into the future. But let's keep things very simple. So let's just say it's 8%, and let's say the inflation rate is, let's just keep it as 4%. It's just nice and easy. So you've got $5,000 in the bank. If you put that $5,000 to work in the stock market at 8%, you would have $5,400. I think everybody knows this, what compound interest is. Obviously, if you are understanding personal finance, I think one of the best things to understand initially is how compound interest works. So as you make more money on your money, that obviously compounds throughout time, and you can basically see that relationship here. Now, what is also very interesting to pay attention to is the value of this $5,000 after 10 years and after 20 years. Now, the reason why this is very fascinating is because in my previous videos, I was basically highlighting that the central bank is basically printing double the amount of money every 10 years. So from a let's say purchasing power perspective, your money doesn't actually go up in value. It gives the illusion that it's going up in value because the dollar is going down in value. Now, how we can basically articulate this is, let's say you've got a glass of orange juice and you add 4% water to this orange juice every single year. Obviously, throughout time, that orange juice is not going to taste like orange juice anymore. It's going to be diluted. So the inflation rate or the dilution rate is 4%. So if you just left $5,000 in the bank after 1 year, you would have $4,808. Again, this is very important to pay attention to, because if you are giving loans to anybody and you are not charging them interest, this is this is something to pay attention to, because you realistically want to be charging them the inflation rates just to keep pace with what you've currently got. But because the nominal value does not necessarily change, the purchasing power does change. People just think, oh, well, I've still got $5,000 at the end of the day. But that $5,000 does not buy you the same amount of goods and services a year later, 5 years later, 10 years later, 20 years later. So it's very, very important to pay attention to, because money just left in the bank is slowly melting away. And this is all to do with inflation and obviously government intervention and dilution through currency debasement. So what we can do as well is we can adjust for inflation, and that's what I've done in column D. Now, you might be saying, well, why is it not just 5,200? You basically take the interest, let's say the large number. So let's just say we did it with 100,000, for example. I've done it over here. But what you would take is you would take $108,000, because $108,000 is 8% of $100,000, and then you would take the inflation rate, what is 4%. So that would be $104,000. And what you do is you divide 108 by 104, what would give you $103,846. So it's not exactly $104,000, but the reason why this is massively important, you might be thinking, well, that is a little bit, why are you being so accurate and so correct? Because these numbers massively compound over time, and this is why it's very vitally important is that you understand how fees work, specifically on pensions and investments and all the rest of it. And I mean, that is a whole another topic for a whole different section, but but basically it's very, very important to pay attention to how numbers compound throughout time. And we are just talking about this from a perspective of going up in value. Obviously the 8% let's say stock market annualized return Now, you can obviously add other different types of variables into this, such as what happens if you have a credit card at 12%? What happens to the value of your money and everything else? How does that affect your compounding, etc., etc.? Like I was saying, you can get very, very creative with this if you wanted to. And I don't know if I said this already, but this Excel sheet is in the description down below. So if you do want to grab it, you can grab it for yourself, or you can just create it yourself or whatever. But let's just put it back to $10,000. So again, as you can see, that throughout time, the difference between the amount what would have compounded in the market compared to what is currently sat in the bank is dramatically different. So again, if we look at after 20 years on $10,000, you'd be left with $47,000. If you just left it in the bank, your purchasing power would be $4,500. But again, if you looked at the bank, you would see $10,000. But again, you are not getting $10,000 worth of goods and services in 20 years at $10,000 because they keep printing the money. Obviously 4% every single year. This is why you have this dilution. But the difference between if you left it in the stock market and obviously if you left it in the bank is significantly different. I mean, just look at this example. After 20 years on $10,000, the difference is $42,000. And again, this is the reason why you have this debate at the moment in terms of the rich are getting richer and the poor are getting poorer. And a lot of it is very, very complicated, right? It's incredibly complicated. I mean, I'll keep talking about this guy because I just think he's so incompetent when it comes to economics and understanding how money works and currency debasement works. But we have people like Gary Economics, Jimmy the Giant, and all the rest of it who do not understand how all of this works. And, this narrative around taxing the rich and all the rest of it. A lot of the reason why a lot of this is going up in value is all to do with government intervention and currency debasement, and this line item is all happening at the inflation rate. So this is just something to pay attention to. What I've also done as well, by the way, is that this graph just illustrates throughout time. Obviously, if you adjust it, so at the moment we've got $10,000, so it's adjusting all of this graph in real time. But if we change it to $100,000, let's say $100,000, you can basically see that we still have the same numbers, obviously compounding throughout time. So $100,000 in 20 years is coming out at about $450,000. And if you just left it in the bank, it would be worth $45,000. So again, that relationship, the gap is getting wider and wider and wider because the money is getting distorted more and more and more. Now, what is incredibly fascinating, what I find incredibly fascinating, is if you started to value this in relationship to your time. So what I have done is I have got the average wage of somebody who works at Walmart. So the average wage at Walmart is $150 a day. So I am aware, by the way, that there's a lot of variables going on in this, but I just want to illustrate why this is vitally important to pay attention to. So let's say you work at Walmart $150 a day, you work 8 hours a day, you currently get paid $18.75 every single hour. So if you take that money, and obviously if you invested it in the stock market at 8%, after a year, you'd have $162. If you just left it in the bank, the purchasing power would be $144. And obviously adjusted for inflation, it's $156. Now, what is very, very, very interesting is that if you just left that money in the bank, after 5 years, that time, what you've spent, you've lost 20% of the time and energy, what you've put into getting that $150, because it is only worth now, after 5 years, $123. So this might be a little bit confusing. You might be a little bit confused. But what I'm basically trying to articulate is that your time and energy, what you are spending in terms of getting money, is being taken from you. And you don't really see it because the nominal value doesn't necessarily change. It's the dilution what is changing. The prices are going up, not because the prices are going up, it's all to do with currency debasement. And this is something what a lot of people don't even pay attention to. So going back to this example, in, let's say, 10 years, that $150 is currently only gets you $101. Now, from a percentage basis, this means that you've only got 70% roughly of the amount of time what you've spent to get that $150 in 20 years. So you've lost 32% or 30% of your time and energy because they are manipulating the currency supply. So in relation to the number of days, you basically worked 2.5 days for free, basically, if you do not do anything with that money. So it forces people to look for alternatives to park their money in. Do you like property, stocks, bonds? I mean, not bonds, but you get what I'm saying, right? It's like crypto, Bitcoin, whatever. Like, people are looking for different types of assets to park their money to basically preserve their purchasing power. And this is basically what is going on. I mean, obviously, some can say that inflation is quite good because it doesn't necessarily incentivize saving. It basically incentivizes consumption. Now, again, it depends on what you're consuming, right? Because obviously, if you are constantly always consuming all the time, you are not necessarily protecting your purchasing power, you are going to have a lot of people who are feeling very worse off. And this is all to do with the distortion of the money supply. Now, in relation to what we are talking about in regards to currency debasements and everything like that, property is a very, very, very interesting market. Now, I am just going to articulate this in a very, very simple way. Again, if you are in property, if you're in loan management, if you're in real estate, you're doing investments and buy-to-lets, commercial property, whatever. There is so many different variables. I'm aware of them. You don't need to tell me, but I'm just trying to explain this very, very simply, right? But this type of environment is incredibly, incredibly good, specifically if you're in real estate. So what I'm basically getting at, to keep things simple, let's say you are looking at buying a property of $100,000, right? You make a deposit of $20,000. This means you've got a loan of $80,000. So your loan to value is $80,000, right? So you might have heard this term, what is called inflating the debt away. So what this basically means is that as they print more and more money into the system, the debt servicing cost becomes a lot easier and easier and easier, because as the asset starts to appreciate, so the property, $100,000, would go to $146,000 in 5 years' time. Obviously, the rents would adjust. And most importantly, the loan, in terms of the repayments on the loan, will obviously be going down. And the repayments on the loan are fixed. So the loan to value becomes a lot easy in terms of managing. So getting into property gives you the benefit of obviously getting access to leverage at very cheap rates compared to if you were going to do it just like a commercial business loan, just for helping the business out. Obviously, buying these assets, you typically get a lot of favorable rates because obviously the bank uses the loan, uses the property as collateral. So again, if we look at this example, as the property goes up in price, and again, the property is not going up in price, the currency is going down in price. I know this might sound very, very weird, and we are going to be talking about a lot about this, by the way, but what I just want to illustrate is that as the property is going up in price, the debt stays the same, or the debt is getting eroded away because of the repayments, if you're doing capital and interest, or just interest repayments. And what is very interesting to pay attention to is the loan to value ratio, because this is how you remortgage and this is how you take money back out of the property to basically buy another property. So let's say you buy one house here, let's say 10 years ago, and after 10 years, that $100,000 property is worth $200,000. The loan, you've only got $50,000 on the loan. What you can do is you can basically remortgage the loan and pull, let's say, $150,000 out to go all the way back to, let's say, 75% loan to value, and you could buy even more houses, and the cycle just repeats, and it goes on and on and on and on and on. Now, how does this cycle typically end? This cycle typically ends due to interest rates, because obviously some people speculate so much, and they don't really anticipate interest rates going up. And obviously, as interest rates go up, it has a squeeze on the economy, and this is why we are talking about the bond market interest rates, because obviously you have supply, demand, and obviously on the demand side, if capital is cheap, very, very cheap to get, that capital obviously goes after different types of assets, right? I mean, real estate is a perfect example, because you cannot necessarily put a lot of supply on the market at once. It takes time, right? And when you have time, obviously in terms of building property, you have a squeeze on the underlying price, and obviously everything else pretty much goes up. But when the interest rates are going up in terms of the reservicing, but when the interest rates go up in terms of getting access to that, now when interest rates go up in terms of getting access to credit at favorable rates, you are not, let's say, entitled to that amount of money anymore. So you have a lower amount of money chasing property again. Obviously, it's always chasing property, right? But you are not necessarily but as interest rates start to climb, In terms of your repayments, in terms of getting access to credits, it becomes more and more difficult. And this is when you typically see contractions, specifically in credit markets, around lending, around people defaulting, administration, and all the rest of it. And, obviously the cycle repeats, right? Because people are shackled by debt, and the only way to get out of debt is by going bankrupt or by going into administration or whatever. But I just wanted to illustrate to you why understanding how property currently works in relation to currency debasement, how this is very, very good for property markets. Not necessarily just property, right? I mean, just assets in general. And also, as well, what I just want to illustrate, you have different types of time preferences dependent on your age. So let's say you are going to live to 80 years old or even longer, depending on who you are and all the rest of it, diet and, you name it, if you're not, blah, 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 blah. Anyway, what I just want to illustrate is that just how important time is, and converting your time for something what somebody else can print just seems pretty wild, really, because they can control the supply. So again, if you are 40 years old, if you are, let's say, you get to live to 80 years old, you've got 40 years left. Now, to put this into another perspective, you have 40 summers left, right? What is very, 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 very scary. And again, if you have people who relatives who are a lot older, who are 60 years old, they only have 20 summers left. Like if they're lucky, right? 70 years old, 10 summers left. I mean, when you put things into perspective, it gives you a completely different way of understanding time in relationship to money. I mean, I have a friend, I think I've touched on this before, but I have a friend who really understands the value of time significantly, like really, really significantly. And he does not put money above time with his daughter or anything like that. He really, really understands how important and how precious time is and why everybody is chasing money. And, he gave me a completely different perspective on how to look at time, not necessarily in relationship to money, but yeah, there's other things just outside of chasing money and yield and all the rest of it. I know it might sound a little bit, come across as being a little bit condescending, obviously if you don't really have much money in the bank or anything like that, but this can hopefully give you a good understanding of why basically money is broken, and why time is so precious and so important. And it isn't necessarily always about the money. And this is something what I've posted a lot on Instagram. Obviously, I get a lot of comments about this. But again, this doesn't have to necessarily be a Bitcoin thing. I mean, this is basically illustrating the stock to flow ratio. And ultimately, you have the US dollar, you have your money basically divided by infinity because they can print whatever they want. And obviously, you swap your precious time for the money, what obviously they can print. And I don't think anybody should be working for something what somebody else can print. I mean, that's just my opinion. But when you start to look at it from a Bitcoin perspective, obviously you have your money divided by 21 million. Now, you might be saying, well, it's volatile, blah, 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 blah. I mean, this is all in relation to the currency, what you're currently viewing the assets in. If you view Bitcoin in Turkish lira or in Mexican pesos or whatever, the value is completely different in that currency in relation to another currency. So again, it's because you are always viewing things through the lens of the pound, through the because you're always viewing things from the pound, from the United States dollar, from the Canadian dollar, from the euro, etc. So this doesn't necessarily have to be obviously Bitcoin. This can be gold, this can be property, this can be whatever. And again, you want to be looking at the supply, how much supply is coming online, because from a gold perspective, it's roughly about 2% of gold supply comes online every single year. So obviously you have an inflation rate of 2%, but it's very, very difficult to get because you have to spend your time and energy to get obviously gold. You can't just print more gold, to a certain extent. So this graph is just illustrating the relationship between the stock to flow ratio. This is called a stock to flow cross asset model ratio. And we are not going to get into the ins and outs of all of this, but basically as assets become more and more scarce, you typically find that the value or the market cap of them assets are going up significantly in value. We have gold over here, we have real estate over here. And again, from a real estate perspective, you can make the argument, well, they are going to, they are going to build more and more property. And what I would say is that even though that is true, right, you have a significant amount of regulation. Now, if you are in a very desirable area, I mean, let's just take Bali, for example. I mean, I spent a lot of time in Bali, and to build a property in Bali, it is getting access to land is very scarce, and it's the same in Miami, right? It's the same in Hawaii. It's the same on Malibu Beach in California. Pretty much wherever. But when you start to go to areas where they are constantly building property, let's just take the south of Spain, or just in Spain in general. I mean, there's a lot of holiday homes in Spain. And there's a lot of people building apartment blocks for holiday homes, and so there's more supply coming online. So within different types of, let's say, assets, you have different types of cohorts of return. So you might get a better return in the UK in relationship to the Netherlands, or you might get a better return in the Netherlands in relationship to Belgium, or whatever. And again, it's just looking at things from a global perspective in a currency what is not necessarily heavily manipulated. And this is why I think it's very, very interesting to value your entire net worth in relationship to Bitcoin or gold or something what is very scarce or has a very high to stock to flow ratio, because it will give you a completely different perspective on how to evaluate your time and money. And specifically around your time as well. Again, if you are working in Walmart and you are obviously on $150 a day, you don't necessarily want to be storing your time and energy in the dollar, because it is being printed, let's say 3%, 4% every single year. You would prefer to keep your money or your time and energy in something what will preserve your purchasing power over time and space, and that typically is like gold, Bitcoin, property, or whatever. And this is why you typically see capital trying to seek higher levels of return or just preserve their purchasing power. So anyway, hopefully this video has been informative. I was going to talk a lot about private credit, about how credit and loans have a significant impact on small to medium-sized businesses. I've been gathering a lot of information from people around the world, specifically in Canada, the US, the UK, about how easy it is to get access to, let's say, $100,000 in terms of lending, or $50,000 or $25,000, and what is the interest rates on them loans. And you'll be absolutely shocked in terms of the interest rates, what some people are actually charging. Obviously, there's risk with that, with these loans, right? There is a significant amount of risk. But all I'm basically getting at is that for a small business to repay 22% interest rate on a loan, you basically need to get a return on capital of at least 22% to basically just repay the loan back. So, and if you could do that, you wouldn't necessarily need a loan. So anyway, that's going to be a video for another time, possibly, who knows. But like I said, if you want to get access to this Excel sheet, you can. It's down in the description box down below. And to the 4 people who keep on supporting me, I hope you're having a lovely day, and take care. Bye-bye.